Welcome to the Matthews Strip Center Roundtable. We're ready to kick off right now. Well, welcome everybody to the Matthews Strip Center Roundtable. We appreciate everyone coming out. We know some of you guys have traveled, in some cases, partway across the country to be here. So we really appreciate the great turnout. We're excited about a great event today. Let's dive in. So just kind of like a brief background of the recent history of strip centers. So we've noticed that there's been some early adopters in the area from the investment side, and then coming out of Amazon where everybody was thinking retail was going to be dead. And now we're at this point in the post-COVID world where really we're starting to see occupancy across retail being 95, 96%, and unanchored retail strips being really performing at record high occupancies. So what I'm going to do is kind of start with the groups. You're all on tables that are somewhat arranged in groups. So I'm going to start with John Morgan Jr., Rob, and Kristen Nealand, and Ryan Moore. So you guys are some of the early innovators in the space. So Kristen, why don't you kick us off? What drew you to the strip center space before everybody else found out?
Do I talk into this?
Yeah.
Okay. Yes, so you're not wrong. We are incredibly drawn to this space, so much so that we have now aggregated one of the largest portfolios of this unanchored strip product. We own about 200 assets across 30 states, valued at just a little bit over $2.5 billion and growing. And even though we've been focused on this specific strategy for the past 10 years, Crow Holdings has been committed to retail since the very beginning. So just to rewind a little bit, Trammell Crow himself had a mandate that all Trammell Crow company employees begin their career on the leasing side. He was a very firm believer that real estate is a tenant-driven business, and he's not wrong. And so when our CEO, Bob McLean, got his start, he started out leasing, and he started out in this product space, in the small shop space. And Bob quickly was able to identify the many positive attributes associated with the strategy, the main one being how quickly it leases, faster than any other product, which was very important to a young broker trying to make money early on in his career.
Right.
And so we refer to this product type as the multifamily of retail. When one tenant leaves, you just sweep the floor, change the locks, turn it over to another tenant, and go on.
Yep.
So when it came time for Crow to offer our investors our first sidecar fund, it was really a no-brainer, and it was simple. We wanted to focus on these strip centers and leverage our 30 years operating in this space. The product was institutional in every aspect but size, and the concept was simple enough for all of our kids to understand. You can't get your hair cut and your nails done on the internet. And if your iPhone breaks, you're probably going to go into the iPhone repair place and get it fixed, even when times are tough.
Mm-hmm.
So that's how it started.
Great.
Yeah.
What about some of the others here in this group? What drew you guys to the strip center space early on before everybody else kind of figured out?
I mean, if we're allowed to say what she said, I'd like to start there because that was
your
really, really well done. But I mean, I don't think we need to belabor the point. I think fundamentals, phenomenal. I think this group got in maybe when retail was going through a recession, right? I mean,
right.
Wildly contrarian. I mean, in 2017, right, you had Amazon buy Whole Foods. We were all decently sure that meant the end of brick and mortar. Then COVID happened. Mm-hmm. Now we're 100% sure brick and mortar, will not exist. And then, obviously we know the strength of it today kind of as part of the logistics. So from my standpoint, the only thing that I would add is the capital markets play, the positive leverage, the yield in relation to other sectors, right? It probably is the only sector today. And I'm going to talk about all retail. And I think unanchored probably is the best within the retail segment. Is what other sector today has capital markets opportunity, meaning potential cap rate compression, being dislocated from 4 and 5 caps of industrial multifamily on top of the fundamental story?
Yeah,
Rob,
I mean,
John, yeah.
I would echo, I mean, they've taken most of the points here, but just the herd mentality that exists in commercial real estate investing in general is so powerful. And when you watch, capital pour into something like multifamily and industrial, like we've seen over the past 5 to 10 years, something's not right. And when capital pours out of something like office today,
Right.
there's going to be opportunities that exist there. And
Right.
so that was, we're a diversified investment company as well, similar to Crow Holdings. So when we're watching some of those cap rates plunge for apartments and industrial with supply coming, we kind of scratch our heads and we're like, it doesn't really make sense. And so going back to the basics and the simple mantra of you can't get your haircut online, it was more capitalizing on that negative sentiment of retail.
Right. Right.
Yeah, I mean, again, well said. Only thing I would add is typically when you have these supply demand dynamics, you see a new supply forthcoming. And I think all of us here wouldn't be here if we didn't believe in the capacity of these tenants to be successful over the long term. But when you have no new supply and increased demand on top of tenants thriving, then that is compelling all of us to step up our rent assumptions and underwriting all those things that are causing us to want to do deals today because we believe in the thesis probably more than we did when we even started.
Right. So let me shift slightly. We're going to focus on really another group here, which is Derek Walczek with Shannon Walczek, Tom Hahn with Prudent Growth, and Dusty Batsell with Baseline, and Christian Chambly with Ziff. You guys are also, very much veterans to retail real estate, and particularly, in many cases, the strip space. Just along those lines, what did you see maybe before everybody else saw the opportunity? What was there? And Derek, I wanted to ask you kind of what you've seen change throughout the years, maybe too, if you want to kick us off.
Yeah, it'd be great. Thank you. The beginning of my career was I spent 10 years as a tenant rep, and then did some strips on the side, developed some. And I think it's been interesting to watch the space change and really grow and professionalize. If you think back to like the 90s, these were, I don't know, there was, other than you in Atlanta, I don't know how many programmatic developers there were. It was more opportunistic. You might have some land left over and say, well, what do we do with this extra, quarter of an acre or 3/4 of an acre? It's like, well, let's just throw up shops. It was almost in the same vein of self-storage that you see in the country.
Right.
You know what
right.
I mean? It's just individuals, capitalists doing that. But, over time you saw rents really start to grow. I developed my first center when I was 25, and I think we did it for $100 a foot. We built the building, you could do it. You could do it even cheaper before then. But what you've seen, I guess really two broad points. What I've seen is where rents stay flat for a period of time, for a number of years. And then particularly like in the early 2000s, rents, at least in the Birmingham market, we were at 12, 14. And then all of a sudden we jumped to 18 for new centers. And there's these moments in time when rents really grow in our space. And then usually supply comes online and douses that. Right. And, you kind of settle down for a while. And I think 2006, when we had sort of that we had way too much retail being built that answered that. And then the Amazon effect comes in, and then you have 10 years of nothing being built. Right. And where rents really just kind of hung out. But then now we're in that period again where there's not enough retail in the United States or in most markets, and the rents are just getting pushed. Add to that just our proclivity to spend money just discretionally, whatever we want, and experiences. And I think we're in a really good place right now. I would say that's been interesting to watch that change.
And it's echoing what everybody said. I think a point that I haven't heard made as much is just the evolution of the space from, retail tenants that are selling things to service-based tenants that are providing, services, right, to the community. So when we look at a center, probably the most important thing to us are the tenants well supported? Do you see reasonable MSA growth or stability there? And, if you lose that guy, like a martial arts studio or something during COVID, what are you going to put in its place? So we like, easy to backfill kind of spaces, modest rents. But medical has been huge. Every center that we have now has probably a medical tenant or a veterinarian clinic or dentist, in there. And we had to remind a lot of our investors during COVID that who are all freaking out, that we don't own a gym. We own the bricks and sticks in a well-located suburban shopping center, and there will be demand for that space.
Yep.
And there was, so we've maintained 95, 96% occupancy across the portfolio.
Excellent.
And I would say for us, it's been just witnessing what happened with our own portfolio. When Baseline started, kind of had our hands in everything. There was some, light industrial, there was some office, some medical, and then retail. And just over the course of the first 5 to 10 years, what we saw to be most successful and most resilient was retail, and in particular, more of the unanchored multi-tenant. So, once we got rid of some of the older stuff, shifted with that, really dug into why it was successful. It's because a lot of the points that everyone's hit on, while the uses change, when you got this small shop space and people are looking to grow their business or they're thinking about starting a business, they're looking for something that's a little bit more affordable, a little bit more attainable to start out, which typically ends up being a lot of the stuff that we own, which is, I'd say more Class B, B+ centers that are affordable and accessible to a lot of these small businesses that are starting out. So, one of the examples that we use a lot internally is internet cafes were all the rage, when kind of this started. Obviously that industry has completely gone away, but it's been backfilled by, whatever use you want to think about now that's been a hot topic, boba tea being one that, we see a lot of now for whatever reason.
Pilates.
Pilates. I mean, fitness, but that's the other thing. Fitness, that's changed over time too and evolved, but the uses, or excuse me, the concept is there. So the use might be tweaked a little bit from, a gym to, now it's Pilates or, some kind of hot works or whatever the case may be. But I think for us, it's just been the consistency throughout time.
It's tough being the last guy. It's like, I'm glad there was at least one thing that hadn't been said. And so I use the term unapologetic a lot around my office when looking at retail. And if anybody on my team ends up watching this, they'll probably make fun of me. But if you think about all of the ways that we shop in bricks and mortar, the strip center space is probably the most functionally unapologetic place or investment vehicle that we have and shopping interface that we have. It's just pure convenience. It's easy. In most cases, it's easy to get in. It's easy to get out. It's visible. It's right there in your face. And, we all drive cars and your car can get in and out and take you home. So at the beginning of my career, I did a lot of leasing for lifestyle centers and new urbanist type properties. And, I did spend a lot of time apologizing. Well, I know the facade of this goes the wrong way, or you have to park in the wrong place, or, you have to walk through this little alley to get here, et cetera. You just don't have to do that in leasing for strips.
Yep. So let's shift a little bit to kind of some of the newcomers here. So with Marco with North Pond and Adam Greenbaum with AGW, Michael Godfrey with Stablewood, Naveen with Pico. So Adam, maybe we can kind of start and let you kick off in the small group here. So you guys have obviously been pretty aggressive in the strip space, and I think you've been a pretty aggressive new buyer. I know you bought 6 deals in Atlanta, I think 10 overall, like within the last 24 months or so. So be interested to kind of hear your perspective on strip centers and kind of the popularity and where you guys see the opportunity.
No, I appreciate it. And it's funny when Kristen was done speaking and Ryan started talking, and Ryan said, I don't really know if there's anything else to say, but I'll add one more thing. I felt the exact same way. It's been very interesting to hear what's propelled everybody's excitement about the space as we've been going around, and everybody's been adding different things that I think for all of us are touch points about why the strip center space has been a pretty extraordinary space. I think that we, though, are pretty distinguished in terms of sort of our outlook on the strip center space. We have this ingrained retail mindset as it relates to sort of our perspective on our business. And I'll clarify what I mean by that, which is that my co-founder nearly 30 years ago started a business that today is the largest retail operator of laundromats in North America. And for the first few years of that business, and even really for the first few decades of that business, he was operating in the retail sector as a non-credit business. And he ultimately, developed a senior management team and scaled that business and studied a lot of principles about the retail space that are part and parcel with our business today. So for instance, really understanding what makes a strong retail site, versus what makes a weak retail site, and also what sort of some of the illusions are that would make one person think it's one versus another. How to think about build-out costs, how to think about the landlord-tenant relationship, and ultimately how that translates into a lease document. And I think that for us, we really ultimately share in that ingrained mindset for our business. And when we connect with tenants, we have this unique ability to connect on the way in which they're thinking about their growth, thinking about whether or not it's going to be sustainable for them. I think the other thing that I mentioned is that we cut our teeth in the mom and pop retail business in the sort of highly competitive New York City market. So I think that one of the things that's been really fascinating as I've been talking with other groups is that they were able to see that the strip center space is this strong space in retail when there was sort of national struggle ongoing, whereas we, working in places like the Bronx, Brooklyn, were able to really kind of acclimate as strong landlords. That's made it easier to come into markets like Atlanta and, grow nationally.
Anything else to add, Michael? Or
Yeah, I think most of what's been said, I completely agree with, and the reasons that we got into the space. The one thing that I think perhaps we thought about too was the ownership of the centers, like the fact that they've been owned predominantly by private individuals or families, and so therein lies some opportunity that they've left some stuff on the table, whether that's through poor management or through not pushing leasing. So I think that's another facet that we looked at. And the other thing I'd mention is Derek talked about the fact that these are well located. For us, we look at the dirt first. We want to be in areas of the country that we deem are healthy tissue or is healthy tissue. We've got a lot of tech and data, and all of that is really focused on helping us identify that. And another facet that drew us to the space was these strip centers are located generally in areas of the country that are serving a neighborhood. So there's good population density. There's a level of household incomes, and there's growth there as well. So those are the only other two things I'd add.
good stuff.
Adding to that, I mean, I think with the fragmented ownership and smaller deal size, it keeps institutions out. So it kind of creates an opportunity for smaller groups to start these firms and unlock opportunity and provide value to investors or whoever may be in the space. So I think just adding to that helps attract more eyes to it.
Right. So I've got an Atlanta group here. We're in Atlanta, so I wanted to bring some great Atlanta representation here. So Ron Chanin with Riverwood and Rafat Sheikh with Safeway and Jeremy with M&P. So some of the ownership that you guys have maybe is a little more diverse across anchored and unanchored. I know, Ron, you're strictly on the unanchored side, but with ownership that's a little more diverse, how does the strip center really fit in to what you guys are doing?
Well, I'll start. I think we got into more or less the strip center probably 10 years ago, and it was really a function of we traditionally were a grocery anchored shopping center owner, but we couldn't afford them anymore. Everyone else was buying them and we couldn't afford them. So a lot of that was a function of where can we buy real estate that fit our price point. And a lot of that fell into the unanchored strip. And we deal on top of that. Our portfolio probably still is 85% mom and pops, even though that's not what M&P stands for.
Sorry, what does M&P stand for?
It actually stands for Morris and Pearl Ann. It was the owners that started the company. Morris was the owner and Pearl Ann was his wife.
Got it.
So
Got it.
that's where it came from. It fell well within what we do is dealing with the mom and pop owners. There's a lot of challenges with that, but we've also found that the mom and pop owners who are actually the operators of the business will fight tooth and nail through the downturn, through COVID, through anything to keep their business because that's their livelihood. So that's kind of how I don't want to say fell into it, but made that transition of dealing more in the strip retail.
Got it.
For me,
Yeah,
I
sure.
can say I am only in the unanchored aspect. And we started in the early 90s, really as a developer.
Yep.
And we looked at all different alternatives. And frankly, this model, the unanchored model, was the easiest way to get in. And we developed probably 125 strip centers in the Southeast. We own a bunch, not that many anymore. And we manage and lease 125 properties. And it's important to understand the business. So being a developer makes us understand how to manage a product, I think, a little bit better. So,
Fahd, anything to add there on the strip center side?
Yeah, I like the market at this time. I haven't seen this since last 40 years. So for the strip centers, the market is so good. There are so many tenants in the market.
Right.
And we lose one tenant and we have 4 tenants looking at that same space,
Right.
I have not seen this type of market in last 40 years,
Yeah,
I
we're
think this
seeing
is the
record
best market,
occupancy, I
yes,
think,
yes.
across the board for retail and
we are
particularly strips.
almost 98% occupied.
Wow, that's great. That's great. Is that across your whole portfolio?
Yes.
Wow, excellent. Okay, so I'm going to shift a little bit to a few individual questions, and then I'll have some kind of open questions as well. So let me ask John Morgan Jr., you've been obviously in this space, one of the early innovators. Why do you think the strip center space has garnered so much attention just say in the last 24 months or so? Like, where's this coming from?
I wish I knew the answer. 'Cause it was a lot more fun before 24 months ago to do this. But I think it's been, retail's been so dead for so long by by all the experts. And finally that gave out, that trend gave out, because retail, and then coming out of COVID, when everyone was sure retail was going to struggle, it had, once you got kind of past the initial COVID outbreak, it rebounded incredibly well. And so I think that caught people's attention. And then you had, in this space particular, you had some big trades and big announcements, probably kicking off with Crow and their transaction. And it brought, all of a sudden, it established it as a real asset class. And if Crow's doing it, first of all, that means people should pay attention.
Right.
And if they have an actual transaction they pulled off, that brings a lot of eyeballs. And then you had Curb with their recent IPO.
Yep.
And so I think you have headlines now to support a thesis that was too risky before.
Yep.
Because if anyone had invested large dollars prior to this and it had gone poorly, they would have been looking for a new job, right? There was no way to say, the herd mentality you were talking about, there was no cover here. And now there's cover, there's a thesis, there's evidence, there's data, there's headlines. So all those things coming together, I think, have brought a lot of attention, and dollars have followed that.
Yep. So just piggybacking on that, let's talk thesis for a minute. Rob, I know I've read you write kind of about, the thesis and sort of this idea that really, a retail center doesn't need an anchor to draw traffic. And I know your thesis might not be exactly that, but it encompasses some of that. Can you expand a little bit on that? I know you've covered a little bit of it already, maybe.
Yeah, and I'll also just piggyback off of what John was talking about, and then I'll answer your question. But, the other part is, the institutional adoption of niche sectors. And if you go back to like the early 2000s, you started with self-storage and student housing. 5-ish years ago, you had last mile industrial. And these are all kind of niche sectors of the major asset classes that have always existed. But it's not until the institutions catch on and say, hey, you know what? This actually niche sector does really well. We should start buying it. And it takes that data, it takes those headlines, it takes that air cover for the institutions to finally move in. And we think that, iOS is out there right now getting some of that attention. SFR is kind of, and BTR is another acronym. But, we think that is also a reason as to why this is picking up. It's just the natural evolution and institutions looking for other ways to deploy capital. A lot of, why we don't need an anchor is really about what Michael was talking about. It's about the real estate first.
Yep.
Right. And we call it loaves of bread, right? If you have a rectangle on a highly trafficked road that chops up into homogeneous suites, you're probably going to be okay. You're going to have an apartment of retail that is going to be pretty easy to backfill.
Yep. Let me bounce around a little bit. Christian, I was going to ask you this one. So, beyond the investment model for strip centers, we've been seeing and it's been touched on a little bit already, but kind of this shift in shopping behavior towards convenience. And I think you've obviously, that's a large part of your thesis still. And are you, talking about this unapologetic strip center, do you think it's something you guys will focus more in on moving forward?
I think so, to the extent that we can. I think competition is going to cause us to look a lot harder at how these assets can function if they do have some imperfections. I know that goes kind of against what I was saying prior.
Right.
But I think we're all going to have to look a lot harder just based on competition. I mean, when you have institutions, when you have Curbline, when you have Pico getting into the game, it's it just creates a lot more eyeballs on the assets that we've all been competing for.
Right.
And I do think we do have additionally with the internet a lot more destination tenants and a lot more, although I definitely prefer convenience and the impulse of turning into a shopping center because you see something you want to do. But we also have a lot of people that are being driven there to do one specific thing. I think Tom mentioned medical a minute ago.
Yep.
You're not driving down the street and seeing a medical tenant and deciding you're going to go in and get an exam.
Yeah.
So I think that's going to have a lot to do with it. But certainly, convenience is going to be top of mind.
Right. So Marco, let me ask you this one. So, we've talked a lot about the small space sizes being kind of easy to lease, and I like the loaf of bread term. So, number one, how does that focus in or factor into North Pond's investment thesis? And then maybe to just piggyback and shift the question a little bit, there are a lot of these other centers that are not loaves of bread, right? They're laid out in interesting, non-conventional configurations that aren't optimal for access or sizes. Sometimes you have medium-sized space that are like 5,000 square feet. Tell me where you guys stand on that and kind of what your philosophy is on that standpoint.
So I think North Pond kind of 15, 20 years ago, we cut our teeth with some of those spaces, like in retail with some of those tougher to lease spaces, or maybe in urban areas where it's not a straightforward layout, but you understand the tenant demand, you understand that sub-market in that real estate. And so there's demand there. So I think if you understand that the real estate's good for those awkward spaces and you can kind of find a creative tenant to get in there and fill that, I think that gives you confidence in your ability to lease that and operate that. And I think with us starting with that kind of more value add stuff or focusing on those tougher spaces, we saw that, okay, these loaf of bread spaces, these small bay easy spaces, these ones, there's tons of demand. We can easily backfill that stuff. So I think that's kind of what got us really interested initially, is like, hey, we can go execute on this strategy and just buy these more straightforward strip centers and try and buy them at scale and build out a portfolio that way in these high interest markets for us.
Let me shift like a little bit to tenancy. Kristen with Crow, I want to ask you this one. So do you view mom and pop tenants as valuable to your properties as national credit tenants?
Yeah, look, we like credit just like anybody else does. And I think people think that Crow only chases credit, but we do see the value in local and regional tenants as well. We know that the tenant mix in our center is super important to the synergy for it to be operating well. And we always say that across our portfolio, we have 1/3 tenancy that's corporate, 1/3 at regional, and 1/3 that's local. And look, people like local flair and not just corporate chains. If you think about the Willies or the Goldbergs located right here in Atlanta, people, they're household names. People keep going back to them. And they continue and they will continue. And also what we love about mom and pops is that there's communication and there's transparency. These are family businesses that are paying for their kids to go to school. They are helping pay their mortgage, kind of like what you were alluding to earlier. The decisions for these businesses are being made at the dinner table at night and not in corporate boardrooms, which is super helpful for landlords also. So yeah, we are firm believers in mom and pops, and when you think about the top national tenants today, Starbucks, Chipotle, Jimmy John's, those all started out as neighborhood restaurants. And to go back to COVID really quick, because I know we're all sick of talking about it. Some of our worst actors during COVID were the corporate credit tenants, which we still remember. And we really saw a lot more transparency and communication and collaboration from our regional and local tenants. So we value it all.
Interesting. So I have a question that's kind of like, I want to get Ryan's input here, and then Adam, you as well. So like last mile, I know you guys are kind of unique in some instances, like when you're setting up a corporation, you're acquiring, shopping centers. You guys are more than pure allocators of capital. You guys have, an operating platform as well, and kind of have a lot of tenant relationships due to that. So I think your perspective is pretty broad. And then Adam, I know you have a lot of mom and pops in yours. So just kind of continuing this discussion with mom and pop tenants, are you likely, so you've got optimal commitment from a mom and pop tenant, you have a choice to make between them or national credit tenant. Which way do you think you generally go?
Yeah, I mean, there's a lot that goes into that, but at what point we take a look at the merchandising in the center. It's an overused term in a lot of ways, right? Like, what does that really mean? But like, do I need this or do I need that? I mean, we've got plenty right now of spaces where a national tenant went out of business.
Right.
Yeah.
We have a pizza place right now that is local doing $4 million out of 1,500 square feet that backfilled a national tenant. So at what point should we be talking about sales, not credit? What is the definition of credit, right? So a 40 unit operator that has a 30-year history, that's doing well, that's signing personally, that's vested in the store, right? And we've got some really interesting perspective into a lot of franchise business. And I'll tell you, if you were to look at the franchise sales or the corporate owned sales, you'll see pretty quickly who you want, for the most part, running those stores, just even within those national names. So from our perspective, we're looking to add traffic, add merchandising, and whoever is going to produce the most sales that can actually support the rent, because there is a lot of retail out there, not to kind of pull, right, that rents are getting to a point that are more supply driven than maybe sales driven. And that's a lot of what we're looking at as operators. But we've got a healthy mix of both. And our definition of credit isn't necessarily a corporate guarantee.
Right.
Yeah, I think Ryan, I think you really explained it perfectly. And I think one of the things I would add to what Ryan was saying is that, a lot of it is about the composition of the center. And it's not really just about how well is this tenant going to do, but it's also about how much additional traffic is this tenant going to draw for the remaining tenants in the center. And that's why oftentimes we'll even think about, if we have two tenants that are competing on the same space, maybe one tenant is even willing to pay a higher rent than the other, but the other one would be a better draw to potentially propel better economics on future leases or renewals on other spaces. And the other thing I think is really interesting, and I was thinking about this when I was listening to other people talk earlier, clearly there's been this relaxation around some of the anxiety in the retail space. And I know Kristen mentioned sort of the multifamily of retail and strip centers and this increased backfillability. And I think that one of the things that's really fascinating about that is that even though if you lose a tenant, you may have an opportunity to relatively quickly replace it with a new one, we all know the pain that is sort of endured when even if you backfill on a quick basis, you had whatever concessions when you signed your original lease, you have your new concessions for your new tenant when they come in, you have downtime in between, you have free rent in between. So even though there's sort of a stronger backfillability in this environment, I think one of the things that for us has been really important, and I think Ryan, you sort of touched on this, we have this very judicious approach in sort of, you can't say yes to every tenant. It's not just about leasing quickly. It's about really understanding what their P&L is going to look like. Right. That's one of the things I touched on earlier in terms of sort of our background and sort of how we framework thinking about a potential tenant. Oftentimes you have a tenant coming in and a lot of landlords are responding just to the excitement that they have to take the space. But it's just really important to us that we really believe that they're going to be successful. And I think that our threshold for that matters more than theirs.
Yep. Ron, with Riverwood, let me ask you, what do you think makes for a successful tenant in one of your strip centers? Or have you seen like common themes or something that would be
common
noteworthy?
themes? First thing is you've got to have a good operator, somebody you feel comfortable that they can operate in your location, because not everybody can be successful. So the numbers are critical in terms of, in terms of the financial, but the individual is probably the most important aspect. Number one, are they going to be operating the business, or are they going to hire someone to operate the business?
Right.
Makes a big difference. But we as a company, we probably have 25% national, 35% regional, and the rest of them are probably local. The local are the, as Kristen said, the local people are going to work very hard. During COVID, I think I lost out of 700 tenants, I lost 3 because we worked with our tenants. We knew it was going to be difficult to replace them. But the local guys were by far the best ones to work with.
Right.
The national tenants, many of which were very, very difficult.
Yep.
We got it worked through with everyone, but it obviously took some time. But in terms of what kind of tenants to put in the center, mix is critical. When we develop centers, we've always done this. We generally do about 30 to 35% food, and then we do quite a bit of service and medical, and that's a good mix for our centers. And I think it's a good mix for any type of unanchored center.
So let me take a quick, just small step backward. So we're talking about credit versus local tenants. So just a quick poll, just raise your hand for one or the other. So who's the first to ask for a rent reduction? National credit tenant or mom and pop? If you think national tenant, who says mom and pop? Okay, all right, interesting.
But I think just to add a little bit of color
Yeah,
there,
please.
for us at least, I think it has to do more with the fact that we're in better communication, kind of going back to Kristen's point with our local tenants. We see them more, we've got a better relationship with them, a more personal relationship with them. So I think that probably has something to do with it. But going back to the COVID example, in situations like that where things are turning south, I feel like nationals are going to be the ones first and foremost, because it is in a boardroom. They're looking at their
Right.
store counts. They're looking at the top 10 or bottom 10 performers and saying, okay, we got to, let's get out of this, or we need to reduce rent. Or, they're hiring tenant rep brokers that are saying the same thing, right? Like, let's go
Right.
look and see where we can reduce rents, and we're going to push really hard because we're getting compensated for that. So I think in times of stress, I would say it probably leans more national.
Right.
In terms of their proactiveness, but in times of like just normal operating times, I think it comes up more frequently because we're asking our tenants, how are things going? We're trying to get as much information as we can as soon as possible so that we avoid the scenario of, we're approaching an expiration, we're talking about a renewal, and we find out that they've been struggling. So, we're trying to have those conversations a lot sooner in the process, so maybe we can help them work out, because
Right.
once
Right.
they know, okay, we've got a landlord that's willing to work with us, and we're just going through a tough phase right now. Maybe I lost a store manager, maybe I went through a personal event, and there were a couple of months where sales struggled. We just need to get through that, and then they're going to be back and forth, because like everyone said, these people, this is their primary livelihood.
Yeah. Yep.
The other thing, just to piggyback on that too, is when you think about holistically, TICAM, replacing an air conditioning unit, what's tenant responsibility versus landlord responsibility? We always get asked for stuff by the mom and pops that, hey, your lease says you've got to replace your own HVAC. But that's a negotiating opportunity for us to say, okay, we're better capitalized than our tenants are. So sure, here's
Right.
a $12,000, 4-ton unit on the roof. Let's talk about a very modest rent increase, or lease extension or early renewal. So there's that opportunity to have that give and take that
Right.
usually the cap rate impact for us of giving $5,000 or $10,000 in a one-time situation, we get back $1,200, $1,500 a year in a rent increase. It's a very nice multiple of that. That's part of our value add strategy, quite
Yeah.
frankly. And then that ripples into like TICAM reconciliations at the end of the year. They owe an amount. Let's have a negotiation. I'd much rather walk away from that and get extensions on lease term or higher rent rates. And the nationals, you can't even have that conversation. Really.
Yeah. Yeah. Right. Interesting.
So what do you think the impact is on your cap rate, like at exit, of having more national retailers? Because that's something we think about all the time, and it's like, what's the right mix and what impact does that have on exit?
It kind of depends on who the buyer is, the ultimate buyer. So a lot of the product that we own is probably similar to Dusty. I mean, you're in the smaller towns throughout the Southeast, $5, $8 million kind of shopping centers. We're probably selling, quite frankly, I'm typically selling to a 1031 buyer.
Yeah.
And so we get decent cap rate compression on the vast majority of our exits. I think we've had like 40 exits in the last, say, 3 or 4 years. And the majority of those are at a cap rate. I would never buy at that cap rate. Let's put it that way. So we get a huge multiple, and they're just looking at like, here's your number. So if we drop a couple grand in NOI from something like that, it's very valuable for us. And they don't care as much about the tenant mix as, you guys might, or a REIT might.
I think it goes too to the institutional players that enter the space. I think when and if that continues to happen, then that will have a biggest effect on cap rates that we've seen. I'm sorry, cap rates and in credit and the need to have credit in accordance with capital.
Yep. Let me shift a little bit to intrinsics, or maybe it's part of intrinsics and including tenancy and some of the things that we've talked about already. Let's maybe more broadly, Kristen, what makes a good strip center?
What makes a good strip center? I think a lot of us up here probably have a similar answer. But as a firm that invests in all different types of product types, we argue internally that retail is the product type that relies the most on true real estate fundamentals that we've all been talking about. That being a hard corner, access, visibility, signage, demand driver, tenant suite size, just to name a few. And then everyone talks about, logistics and industrial and all those trends that drive that. But it's really those exact same trends that are driving this convenience-based retail as well. And just the other day, I was in the car with my 5-year-old and we were driving down the road and he spotted an ice cream shop at a shopping center and started demanding ice cream. He had to have it. And my first thoughts that went through my head were like, can I park easily? Can I get in and out of there really fast? Because I was in a hurry. And if I couldn't, then I wasn't stopping. And it's just those are part of the fundamentals that we look at, just a few of the fundamentals we look at when we're evaluating a new deal because of the necessity-based nature of the product. So
Right.
Yes. Just for the silence. Yes.
And then I bought the center.
And then I did it.
Rafat, you're well known in the value add space. When you're looking at a center for acquisition, what's the most important thing that you're looking for?
Vacancy.
Vacancy.
More vacancy.
There is no vacancy now, right?
Yeah, but I can still find some.
Right? That's right. Well, you've done well. You've got 98% occupancy across your centers, and you're still able to find value add. We may be delving into trade secrets. Where are you finding all these value add deals?
I have good relationship with some lenders and all that.
Yeah.
So I can find deals.
Let me ask this one to you, Dusty. So one of the things we like about strip centers, and I think the reason that they're so popular, as in contrasting to like the net lease out parcely kind of strips that have 2 and 3 tenants, the rents are very high. So how does kind of this idea of seasoned rents factor into your model? And anyone else chime in on this, please. But that seems to be one of the biggest attractions to the strip center model, is like the rents are $10 to $15 or even more below what you would find in maybe like a Starbucks, Chipotle out parcel center that's a regular, like a Riverwood Properties strip center. So I'm asking that very long-windedly. How does the seasoned rents factor into what you guys are doing?
I mean, for us specifically, that's 100% of our strategy. We don't buy anything that's new. We don't develop. We don't buy anything that's new construction. Our preferred, we like to be the third owner in a lot of cases, just because, what we've seen over time is rents are going to get marked down at some point by the time we get involved. If it's second or third generation, then usually they've stabilized a little bit and they're more predictable for us. But I mean, we're very unique in that sense, I think. Our average in-place rent is, in the mid-teens. So that, I think, is for people in Atlanta too. I'm sure that's something you've rarely see, but for us, we like to buy something that is in the high teens to low 20s, and so it's very much the seasoned rent. We we shy away from initial lease terms just because our experience has taught us that there's only one way for those rates to go typically. But I don't know if anyone else has had that same philosophy.
That's really big for us as well. We don't buy new stuff.
Right.
And as you think about how good you can be as a buyer in your own hometown, right? I mean, you pass something, you really know it intrinsically. And then, okay, well, now you need to go buy, in somewhere in California or somewhere in New York that you don't know. So how can you put those tent poles in the ground and know that what you're buying is good? Obviously you've got, some sort of a sales aggregator. You can look at demographics, you can look at traffic counts, you can look at all that, but really you can look at the rent roll, and that tells you so much about the history of the center. And it gives you that kind of ability to make those bets.
And I think with these higher rents, you get sucked into paying too much on a price per foot. I mean, to me, I'm not going to spend $500 a foot on a center, and that's what you're doing when you're buying a $35 or $40, rent on those little 3-packs. So, cap rate's important, rent's important, the price per foot's important. So, yeah.
So Jeremy, where are you guys seeing rents? Are you seeing rents you feel like they're topped out, or you think there's growth on?
Listen, I'll say M&P has always been, we've considered ourselves to be the low cost provider on a block or in a market. We being long-term holders, I can undercut anybody's rent if I need to, because for us, and not that that's what I'm doing, and we are seeing rent growth in our portfolio, but for us, there is a value to keeping a tenant in place than the replacement of that tenant. Even if it is a national tenant, we're long-term holders, so chances are I'm going to own that property from when the national tenant's going to be there at some point. But for us, that cost of your commissions, your downtime, your build-out costs, TI, you have to get such a rent growth in that to make that up over time, and it's that relationship with those tenants. So for us, it's you give a little, you take a little, and I think we've been able to do that because we've been long-term holders. We've owned properties since 1964 in our portfolio. So we really can, I don't have a lot of basis in them, but we're able to work with our tenants to let them operate. And I think that's the success that we've had is, you can push rents as far as we all can, and it's great for everybody. But if the tenant can't make it, whether it's because of taxes, insurance, base rent, whatever it is, what's that good if they go out of business?
Right.
So
just kind of a question for anybody to answer. We're seeing operational costs go up, CAMs going up, taxes are going up. Obviously, insurance is a big thing. That's gone way up recently. Are we feeling like we can still push rents and continue to rise this wave of continue to raise rents? Or do you think we actually may be near the top and maybe see a pullback given that the CAM and everything else is so high at this point?
I think Brian nailed it. Right now, incrementally, yes, just because of the supply constraints, but it seems like that's going to be in place for a little while. But I'd be lying if I said we weren't, starting to be a little bit concerned about that for it to be significant rent growth over a significant period of time, just because of where things are. I mean, operationally, I'd love to hear what you guys are saying too, but that's something we scratch our heads about every day. It just seems like costs are going up way too much.
And it's really hard when you just buy the center. I mean, if you're buying in South Carolina or Florida, some of these states where your insurance is going to be a lot higher than the other guys because your insured value is going to be higher because you got a fresh number, right? And then your taxes are probably going to double or triple depending on how long the other guy held it. So, your center on your side of the street, now you've got to go to your tenants and it's $6 in TICAM, and last year they're paying $4. And nothing's changed other than there's a new price point, the taxes. So that hurts a little bit. If you've got there's a vacancy across the street and they're at $3.50, and so we have had to be patient. Now, eventually, I think everybody catches up, but you're kind of at a disadvantage in this market right now.
There's nothing worse. Like you said,
all you can do.
The new owner that comes in and, you send out, we're looking at it right now because we're putting together estimates for 2025 and, we're looking at what our estimates were to what the seller was, or the previous owner was charging. It's like, well, this is going to be great. The only thing that's changed is the owner, and so it's our fault.
But the other piece of pushing rents is not just, can we keep pushing rents? It's at some point you price out certain business models that can no longer be in the center and afford that. And you may want that business cycle, like you were talking about with your, in your merchandising and your co-tenancy. You may need some of those kind of lower cost, or models that can't pay the tip top rents like a restaurant, but to balance everything else out.
Right, right. Let me shift a little bit to some economic questions. So, Rob, I want to ask you this. You always have your pulse in the economy. Like, overall, the economy looks like we're maybe seeing some weakness. You're seeing some big boxes start to close. Credit card debt is up. The consumer spending is maybe pulling back, maybe not. We've got interest rates that are trying to come down. And meanwhile, the 10-year says, I don't agree with the interest rate. So just talk to us about investment climate right now and kind of what you guys are seeing and what you think 2025 is going to look like.
Sure. I mean, I think in general, economic slowdown or recession is going to happen, just a matter of when. When that recession happens, people will continue to get their haircuts. They're going to not stop getting their haircuts. I also think that everybody in this room may agree with me that we probably shouldn't be operating at 10 consecutive quarters of 97% national occupancy. We don't underwrite that. We underwrite, longer downtimes. Right. We underwrite higher general vacancies. We're having our day in the sun, but the portfolio can withstand an economic slowdown in general. That's kind of how we feel about the general consumer. Again, the stuff that we're doing, I think the things that will get impacted first are your expensive purses and trips to Europe. I don't think it's going to be you're running late for a meeting and you got to grab a sandwich really quick. You're gonna grab that sandwich.
Right.
So we're not as concerned about that. From a I would say capital markets perspective, the debt markets have really warmed up, despite the fact that the index or the treasury continues to increase. SOFR's coming down. Right. So depending on if you're a life co borrower or a bank borrower, you're either feeling some pain or you're feeling pretty good.
Right.
But spreads have compressed. So I'd say in general, we view this as a very favorable investment environment.
Right. So most of those groups in this room here are buying properties not necessarily related to a 1031. And as we've seen, like a lot of the net lease market is at a slowdown for many cases. So a lot of those buyers traditionally are buying strip centers in many cases coming from California. The California run was big for a long time. Are you guys, with the pre-raised money and well-capitalized groups that you guys are here, are you seeing less competition from the 1031s, or is that still something that you butt up against time to time?
We're seeing less of it, but they're still on the bid sheets and I think it's what price point the deal is. I feel like over the $10 million price point, you start really weeding them out, but between that 5 to 10-ish million, they're still active on a much smaller scale than before, but they're still buying and still overpaying. So,
right.
Yeah, we still see them.
I think that the 1031 market also, in that kind of $5 to $10 million range, there's just less tenants, right? So it's not as management intensive. It's not as asset management intensive from a leasing and renewal perspective. So I think that for us, we've really tried to be in that $8 to $15 million range, trying to have more like 15 to 25 tenants. It definitely creates a lot more sort of management intensiveness, but it allows us to not compete as much with that type of capital.
Yeah, our asset size right now is smaller than we'd like it to be. We're at 6.5 million.
Uh-huh.
So we, to Kristen's point, they're still there for the right stuff, right? And we have a net lease program as well, and that the numbers are way down, but again, on the right product, they're still there. So if it ticks all the boxes, and John was saying that before about the general buyer pool, if it ticks all the boxes, they're still showing up.
Yep. Well, on the time I'm going to skip a little bit from what I had planned because Ryan, you and I had a conversation about the challenge in this business, and it's been very rosy, and we've talked about all the very nice things about the shopping center, strip center business. But let's talk about the challenges. Talk about you're trying to scale a business to 9 figures and above, and maybe under $10 million chunks in many cases. You're a people-intensive business. You have investors, you have IRRs that you're trying to reach with the 10-year bouncing around. I know you have a lot to say about that.
every business has its challenges, whether you want to take real risks to get to solid absolute return or go through hard work to get to absolute return. But like, I'm going to take a corporate finance look at this. I mean, for those people that are investment managers, we have an investment management business. We have an operating platform as well, right? The investment management business has gotten skinnier on the economics that you make as it relates to being a fund manager or just a fiduciary of third-party capital. So it's why you're seeing this gigantic trend of institutions wanting to control the platform wanting to get to control, get closer to the equity, because returns, there's not as much scrape as there used to be for everybody to take their piece, and that's just an investment management concept. So from our perspective, what we have seen when we launched the business in 2019 is you need your team to focus 100% on this asset type. It is a grind. It is granular, the amount of deals you need to look at, right? Otherwise, you just kind of simply become an allocator. And everybody in this room has got their own alpha, whether you have leasing intel, tenant intel, locational intel, better cost of capital. You need an advantage to produce absolute returns in today's world. But the other concept is the amount of G&A we've needed to hire to appropriately source, if you're trying to produce alpha, as well as operate, is significant. And I would tell you, if you have an acquisitions team and they're used to buying $50 million deals, and you ask them to go do this on the side, they will gravitate back to the $50 million deal at the end of the day. And so, and then the other part is just, the granularity of the sourcing, right? What a lot of people, of the operations, is a lot of people in these scaling strategies, and I think Crow's done this well. I think a lot of people here have done this well, but where a lot of people have misstepped in scaling small fragmented asset classes, they start to drift. They throw a lifestyle center, they throw a power. Well, guess what? Your leasing team can't operate. It's not efficient. It can't go through the system and get great spreads and be good merchandiser. It clogs everything up. And so it's been, those are the biggest challenges but that's hard work and investment into the corporate, not necessarily the asset. The fundamentals are phenomenal.
Right.
So how do you scale though? I mean, if you're having that challenge with the equity up here, you're buying not $50 million centers, you're buying $5 million, $10 million. I mean, what's the scale? What's the equity saying as investment manager? Your institutional side saying, hey, I need you to put $1 billion to work, right? And how do you do that in the strip center side? And I mean, a little forward thinking, obviously there's not a lot of product out there. There's about, I think, 68,000 strip centers out there. Of that, I think maybe 90% is owned by institutional private groups, funds, so there's a lot of product out there, but it's really hard to get to right now. So I'm curious on the thesis from the institutional side and from the fund side on how you actually scale and how you can actually execute on this platform, because we've heard a lot about acquisitions. A lot of guys have been doing it for a long time, and they're like, hey, I got 100, 150 centers. Guys that have been doing it for a long time in the more traditional retail side have put billions to work, billions and billions. So I guess it's it's a thesis we all need to look at, but how do we get there, right? And where are we going, and are we able to get there, and how that's going to look too. So I'm curious from the institutional side and from the fund side, how you guys are preparing to scale in a big way, because there's huge upside in this market that we're looking at right now for the Unanchored. So.
I'll take a first shot at it. I think the presumption is everybody's playing it as a scaled strategy, right? I think a lot of people are sitting here saying, my platform doesn't need to buy 30 assets. My play isn't to go public. It isn't the inefficiency of what the portfolio valuation is worth versus whether it be public or private. And so, yeah, it starts with the capital, right? And so you got to look at your own strengths. You got to look at your own capital source. You got to look at your own platform as it relates to, do I want to stay 5 people and do 5 deals and crush that 20 to 30 IRR, but be very choosy about what I'm going to get into? Or is my capital a more relative return capital source, which is the institutional space for a lot of them, like pension funds, where maybe they look at it as a grocery alternative where, hey, I don't like where grocery's going. Grocery's going to clearly an unlevered 7 and below, and I can get in at an unlevered 8 to 9. I'm going to play it as an unlevered open-ended. You're starting to see what you see with Nate Creef and the Odyssey, right? Start to, bring those investors back in. And so honestly, you got to look at if you're not willing to invest in your platform, you shouldn't go scale. You should go small and niche and value add. And if you have the opportunity to go upscale, you better make sure you have the capital that can pay the freight for what we're seeing in the space.
Yeah, I would add one more thing. We at Center Square are in the scale game. It's all and now that my phone's listening to me, so I'm going to get a whole bunch of Nick Saban quotes. But it really is all about the process, and you have to if you go back to Henry Ford, there was a process that each person had to play a certain role, and you had to do the exact same thing every single time. You have to have the exact same contract. You have the exact same team doing the due diligence. You have the exact same third-party vendors, and everything just has to be on repeat so that you can produce that kind of scale.
But ultimately, you take what the market gives you. I mean, you can't really exceed that, and so you have to appropriately scale your capital to the degree that you think you can get it out the door. I know Curb's set up for it, but man, I'm at $2 billion. I wouldn't want to be done. I wouldn't want to have to do that. 3? Okay. I mean, yeah, even more. I mean, they'll that would be a lot.
Right. Yeah.
Different game, different cost of capital, right? FFO growth and right versus IRR.
But do they buy in portfolios? How do they do it?
I think they'll look at it.
We all want to buy portfolios.
Yeah.
Everybody here. Yeah. That's why we're here.
Yeah.
We got the secret deals.
Talk to
in the back
Ron
part.
later.
We'll talk later here. So with that as the backdrop, we're kind of piggybacking off that. Everybody has their different models and different setups for their companies. So we may be delving again into trade secrets you might not want to answer, but what are you guys finding that it takes to secure acquisitions now? Is it just price? Are sellers reacting to quick closings? What are you doing to win a deal that you like?
For us,
Information. I'm sorry, go ahead.
For us, it starts with the broker relationship because, some people have chosen, and nothing wrong with it, to attack this market and do cold calls, into specific owners. We've chosen to just use the broker network. And so having those deep relationships with brokers where you really know them, have had some to my house to have dinner. And that's really how at least for us, how we're trying to crack in. And so try to be as easy to work with as possible, knowing that your seller is probably not going to be institutional. It's going to be difficult. There's going to be problems. There's going to be things that come up that, that if you're super rigid in your process, that might create a lot of friction and make it difficult and the transaction doesn't happen. So we try to really care about what we care about, but then at the same time, just be super flexible in handling the transaction and being as friendly. So just basically try to be perceived as that's who you want to sell that center to, because we love that guy or that team or whatever.
What we're seeing right now, in addition to broker relationships and price, but also surety of close and quickness, the speed of close. And I think a lot of people don't realize how, you can offer a 30-day close, 30-day diligence, 15-day close, but the logistics of all of that is difficult. And like Rob mentioned, everyone has to play a role. You have to use your same third parties that you can rely on. You have to use the same contract. And so I think unless you're set up like that, people are finding that that's very difficult. And a track record speaks for itself.
So are you finding, if that scenario you're buying from an unsophisticated private owner, are you finding that they understand that part of that speed that I can execute on as the buyer is depending upon them delivering and giving you everything that they need? That seems to be a big struggle from us as brokers, but are you guys still seeing that as a big thing when you're buying from local owners?
Yeah, it's as fast as they can get us things as well. And I think it's also brokers trying to coach them along and help the speediness as well. But yeah, we struggle with that also. Yeah.
So, all right. So we're getting towards the end here. You guys are in charge. What did I not ask that you wish I would have asked?
I'll ask a question. Who here has a 7-year or more hold period time horizon?
Wow. think we got the wrong group here together.
Are you saying it's tough to effectuate your business plan within like a 2 to 3 year hold?
No, well, I don't think look, I don't know. I think this asset's a very tough 3-year hold and exit period. But I just think it's interesting that so many people have very long-term time horizons. I would expect that not to be the case in most asset classes. So I don't know what that means exactly, but except that everyone's kind of approaching it with similar mindsets, seemingly.
I mean, I didn't raise my hand. So, I mean, I'll say we've always been a little bit, I think, nimble, probably just our investors like that. I mean, we actually do 1031s on every sale. So our attitude is if you're value add, which we tend to be, like stabilized with value add, you're going to have a massive uptick in value in the first 18 to 24 months if you execute. Like the prior owner, we bought assets from guys like, oh, the prior owner didn't do TICAM reconciliation. There was like too much work. They're like, okay, there's $30,000 or $40,000 right there year one on a $5 million center. And then you fill a vacant space and all of a sudden now you've really added $1 million in value to the property. It's probably a 30-40% bump on your equity, and you've only been in it for 12 or 14 months. So then the question is, am I better off owning it now for the next 5 years and ride the 3 to 5% increase, or can I roll out of that into another asset that looks just like that one and just ramp up the IRR faster? So we do tend to, our average hold period's been about 3.5 years. Now there's other assets we're going to own longer, but we're also buying shorter, walls a lot of times. So, you're 3 years in and you only had a 3.5 or 4 year walt at the outset. If you get your leases renewed, that's now your best time to sell potentially. Yep. If I own it for another 7, if I'm in it for another 3.5 years, then I got to go a whole another round of lease renewals with these little 3 to 5 year leases with these tenants. So we sort of write to about a 5-year hold, but we always tell investors, like, don't be surprised if we exit in 2.5 or 3 years. It doesn't mean it's a bad asset. It's a great hold for the next guy, but we're looking for a little bit of a different profile. Best use of our investment.
I think our answer would change depending on how much interest comes into the space. Because I think at the end of the day, most investors are going to be total return driven. Even though you talk about cash flow and you talk about 7-10 year holds, they start seeing cap rates coming down, right? 6 caps, let's just say. And they can look at 18 to 20 IRRs. I'll bet you a lot of our LPs are going to change their decision and say, you know what, this was great. We rode the wave. It's time to exit. And I think, I raised my hand, but I could also see it going the other way and saying, you know what, we're going to start selling.
Right. Anything else that you guys would like to have asked that I didn't cover? So maybe one more crystal ball question, then we'll, unless you guys have anything, I think we can probably wrap and head to lunch. So, all right, recession, right? If we think we're going into recession or we hit this fabled soft landing, we then are in a period where we're going to have lower interest rates. So coming out of as brokers, we're intrigued by this because we think this means more velocity, but with more velocity comes more competition. So you have more properties probably coming to market, but then the 1031 market clicks back on again. Does that pose a threat for you guys, or does that become opportunistic, or does that just depend on how bad the recession has, if we have one?
More properties is good.
Yeah.
That's what I was gonna say.
I like it. More properties come on the market to me sounds encouraging.
But more properties also means you have a lot more 1031s, the market's kicking up. So I guess maybe the question is, was it better in 2021 for velocity and acquisitions for you guys than it is now at the end of 2024?
I think has this not been a really dry quarter as far as what the activity that you've seen? I mean, it's
been like hand-to-hand combat.
It's been terrible. So yeah, it would be better. It was better in 21 for sure.
Yeah.
Guys, you guys have anything else to add?
It's coming. I mean, we certainly have some weakness in the economy, which is going to change some perspectives on a lot of the private buyers that are out there. And we're talking to them already. And we're going to see a lot more product, and that's a debt issue that's coming up too as well. We all know the debt's coming up. I think we ran probably 8 processes last year this year where it was a dual tract where the owners went for the refi and went for the sale, and all except one went for sale. So I think a lot of that, the characteristics of where the market is, where the capital market is, a lot of these groups are just going to want to sell, especially on the private side too, where they don't have the options that a fund has and that an institutional group has to get recapped or bring in other investors. So, from a broker's perspective, we think 2025 is going to start kicking up for a lot of the reasons we've seen people waiting right now and not wanting to sell, interest rates, elections, and those things. And I think Q1 we'll start to see that volume. We already have a pretty significant pipeline in Q1 that's just waiting. It's like, okay, let's wait. Let's get to New York ICSC. Let's tease. Let's go full in Q1. And then Q2 will continue to pick up. And then I think 26 is going to be a big year as well. But we're going to have some bumps in the road going through that. But as long as we can stay on the route, I think it's going to be a really good couple of years for sure. And we're at Matthews are set up to handle it and take that product that's all private right now and really institutionalize it, get the funds into it. And, I think, and I'd be curious to hear what folks have to say about this 68,000 square feet of retail centers that are out there unanchored, essentially. How in 10 years from now, what's the institutional makeup? What's the fund makeup on it? Right now, it's probably 10%, we guess. We really don't know because we don't have the data, maybe 10, 15%. Is that 60% private in 10 years? Is that 50%? Is it 70%? But right there is the pocket of properties, right? We're talking, tens of thousands of properties that this group right even here couldn't even touch. It'd have to be more capital coming in from institutional side. So I think from my real estate side, my geek side, I'm like, that's really intriguing to me is where it's going to be in 10 years from now on this front and where we're all sitting having the same roundtable a decade from now going, wow, we own 60% of the assets in America now. So I think that's exciting for this business, and we're on the kind of front end of it, which is great.
Just real quick, I had a kind of more specific competition question. I know one of you mentioned that you generally don't see some of the same groups and some properties you go after. Sometimes maybe that's not the case, whether it's on or off market. If you know or you feel like a specific property you're going after with some of the same players, so to speak, where do you kind of push the limit in terms of pricing? And it's like, hey, I really want that one versus I know somebody else is probably in the game. Like, where do you make those judgment calls, something like that?
It's really determined by your cost of capital, right? Like I can't make a call to just say we're going to pay an extra 250 grand more. Eventually you're going to hit a limit and your investor, your fund, et cetera, is just going to say no. And so whoever kind of gets to that level, it goes back to Ryan's comment, whether it be your data, whether it be your conviction in the rental rates, whether it be, that location, et cetera, that you may have seen something happen, may adjust your underwriting a little bit. But if you're going neck and neck at the very end, it really kind of comes down to information and cost of capital.
Well, I think we'll wrap. I appreciate everybody coming. This was a great time for me and learned a lot, and just very pleased to have each and every one of you here. And again, you guys are the all-star cast, so it doesn't come off without you guys. So we're very thankful to have each of you here. So pleasure to have you all, and we thank you guys all for coming.